the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power. Our 2-hour program today is given over to the story of President Biden's Fed nominations. We'll be joined by economists Paul Krugman, Larry Summers, Laura Tyson, and Douglas Holtz-Eakin. But first, to set it all up, we turn to Bloomberg International Economics and Policy correspondent Mike McKee. So, Mike, finally we have the answer. I'm not sure it's a shocking answer, but what do we make of it?
Definitely not a shocking answer. As I said earlier, this returns us to the dog bites man way of nominating Fed officials, that the current chairman is reappointed even by a president of the other party. And it is probably because Jay Powell was in a situation where Joe Biden was in a situation where he's got some big fish to fry in Build Back Better and infrastructure, and he wanted to have as little consternation up on the Hill as possible. And since the Build Back Better has dragged out a lot longer than they thought was possible, he took some time to get there.
I also wonder whether he's just tired of trying to get every single last Democrat. On this one, he doesn't have to do that because Republicans have already said, we like the idea. The
ranking member of the Banking Committee, Pat Toomey, was very quick to send out a tweet saying he supports Jay Powell. Powell should be confirmed without a problem. I expect that Lael Brainard will be confirmed as well. It may be a little bit more difficult. She may get fewer votes, but she's not so outside the mainstream, particularly on monetary policy. And that was the surprise today, was that she was named vice chair, the monetary policy job, instead of vice chair for supervision, which everyone thought she would be getting.
Well, that is curious on two fronts. One is, how influential will she be in this vice chair position, which is traditionally the number 2 position, really. Some very powerful people have it. But also, why didn't they name supervisory at the same time?
Well, that's a question that would be interesting to put to Joe Biden. What's interesting is when you look at his nominee for the controller of the currency, who is the regulator for national banks, Saleh Omarova, she's very controversial, very much a strict regulator. So does Biden want to send that message and pick another very strict regulator, in which case he wants to separate these two from that so that the nominations don't get dragged down together? Also, he's upset, obviously, the Elizabeth Warren wing of the party by choosing Lael Brainard for vice chair instead of chair. And so maybe he can make some appointments that would mollify them. And again, he doesn't want them to get tied down in the whole process.
Yeah, good point. We have some more appointments coming. Thank you so much to Michael McKee. For his views on what the president's decisions meant for the Fed and for monetary policy, welcome now Dr. Paul Krugman. He's Distinguished Professor of Economics at the City University of New York and recipient of the Nobel Prize in Economic Sciences. So, Dr. Krugman, thank you so much for being with us. I guess my question is, what does this mean for Fed policy? And by the way, what should that policy be no matter who's at the Fed?
Okay, so it's really hard to find any error between Powell and Brainard on monetary policy right now. We have a extraordinarily dovish, open-minded, flexible-minded Fed these days, one that is really concerned not to tighten prematurely, is willing to give the transitory inflation hypothesis plenty of running room before it really wants to slam on the brakes. And that's true of both people. And I have never been able to get myself worked up about this decision one way or another. I mean, I think they're both really good. Lael is an old student of mine, but that's a reason to actually be even more cautious. And no, it's in terms of monetary policy, we still have the Fed on wait and see. And I don't think it really made a difference on that, which one became chair. And of course, giving Brainard a powerful role in monetary policy even further reduces the difference that this decision might make.
So, Paul, Jay Powell's already said we're tapering. We've begun the tapering process. Now it seems like the debate is, should we speed it up some from what they were talking about, mainly tapering so that we're basically not buying a lot of new bonds by the middle of next year? What do you think about that in terms of inflation? Because that's what's driving it. A concern in inflation is larger than what the Fed had anticipated.
Sure. Inflation is well above Fed anticipations. The Fed was expecting 2.4% for the year as late as March. So that's we're clearly running way above what the Fed expected. It's hard to think that the large-scale asset purchases, LSAPs, quantitative easing, is really important in any substantive way. I mean, there's actually never been really solid evidence that it mattered a lot for anything, except as a kind of indicator of future Fed rate hikes. It's just now, and there's a pretty good. I am in fact in favor of rapidly tapering on the LSAPs because what those purchases do, I think they substantively, they really do almost nothing. And what they do is they create some constraints on the Fed's ability to act. I mean, the Fed, if inflation ends up being less, fading less rapidly or not fading at all than I expect, and I think the Fed expects, the Fed needs to be able to respond. And it would be really kind of embarrassing, not impossible, kind of embarrassing to be raising the Fed funds rate at the same time that you're still buying lots of long-term assets. So in a way, the tapering should be more sort of clearing the decks for a flexible policy rather than anything else.
Well, I mean, Larry Summers well. We have him on regularly, and he says he was a classmate of yours, you're a friend of his, but he has a different view on this. I guess to summarize briefly what Larry's saying is basically, if you're not going to fire until you see the whites of inflation's eyes, we're seeing the whites of their eyes, that it's here now, and why don't we taper much more quickly so we can get to the rate increases that you suggest?
Well, I would taper. I mean, I would taper quickly. I think that's worth doing, but I would not raise rates yet, because the fact of the matter is, I mean, let's talk about how this debate unfolded. Back early this year, Larry and other people, Olivier Blanchard, former chief economist of the IMF, looked at the American Rescue Plan and said, this thing is enormous, and if it has anything like a standard multiplier, it will lead to a drastically overheated economy. People like me said, I don't think the multiplier is going to be very large on this, and I don't think it's going to be all that inflationary. And what's actually happened is that the multiplier has not been very large. If you look at domestic demand, it has not grown at an extraordinary rate. It's grown actually no faster than normal growth in the economy's productive capacity, if anything, a bit more slowly than that. So the low multiplier happened, but on the other hand, inflation really did take off. And so then the question is, well, how do we're having inflation, but it's not inflation according to the script that people like Larry were promulgating early this year. So yeah, they were more right about inflation than people like me were, but they seem to have been right for the wrong reasons, which is, that's an academic discussion. The question is, what do you do now? But it does bear on what you do now. A lot of what we're seeing seems to be bottlenecks, seems to be not so much that we have excessive overall demand as that we've had skewed demand. We've had people still buying a lot of goods and relatively few services, and we run into all of these supply chain issues, which are clearly, those won't go on forever. In time, you can already see there's already some evidence that supply chain issues are letting up, and over time the economy will adapt, and also this skew in demand is gradually reducing as the people sort of come out of pandemic mode and start to buy more, start to go out to restaurants, start to go to the gym instead of buying Pelotons. There's still a question of, are we, even though the economy hasn't grown all that much, are we overheated all the same because of the Great Resignation? Because lots of workers are not coming back to their jobs. And that's what's still kind of up in the air. We don't know that. But the one thing you can say right now is that we do not have any evidence of stagflation, wage price spiral. Wages are going up because demand for workers is high and supply is low. The prices of goods are going up because of supply chain issues. There's no indication whatsoever that anybody is raising prices because they expect everybody else to raise prices, which is how you get into stagflation. We're not in that phase yet. And as long as the Fed is keeping an eye out for that, I don't think we need to be too worried.
Well, as you say, not in it yet, but thus far, at least as I've seen the numbers, wages have gone up, but not as fast as prices. Are they going to catch up? And if they do catch up, could you put you into that wage price spiral? Well,
sure. I mean, but the point is really it's not something you can settle actually by looking at just at the wage numbers, the price numbers. You really need to talk to people. This is one of these things where, we have various measures of inflation expectations, which are all basically junk for this purpose. The bond market is not a junk measure, but unfortunately the bond market doesn't set prices. of goods and services. The consumer inflation expectations we know that consumer inflation expectations are basically the price of gasoline. It's not telling you very much about what people really expect. And so you really need to talk to businesses, talk to workers about what they're doing. And so I at least am closely following surveys like the Beige Book for evidence that anybody is starting to get into a persistent inflation mode of thinking. And so far, there's not a hint of that. It's just not out there at all in the studies. So, you need to be alert, but on the other hand, raising rates, remember the fiscal stimulus, the big fiscal stimulus is behind us now.
Right.
And, effectively, we're going to be seeing fiscal tightening from here on in, even with, Build Back Better will make very little difference to that. And the risk, there's a very serious risk that the Fed might raise rates because it's worried about inflation, then discover that the bottom is dropping out on aggregate demand. So it's certainly not a slam dunk thing, but Larry thinks it is, but
right.
He's wrong.
But Paul, to come back to the Fed for a moment and monetary policy, because as you say, fiscal policy, there's going to be some tightening just as the numbers come off. But on monetary policy, we have two mandates for the Fed. It's both price stability and also full employment. Do we know what happens if those two things are pointing in opposite directions? Because some people would say right now, what we're doing is we are losing some of this price stability through inflation, and we cannot eke out that last part, whether it is women that are not coming back to the workforce, whether it's people of color, that you can run it as high as you want and really risk things, and you're not really getting the payoff when it comes to full employment.
Oh, sure. There's no, we haven't, the lessons of the 70s are not irrelevant here. There are limits. You cannot do an Arthur Burns, Richard Nixon, and just reflate the economy without consequences. On the other hand, that's a long time ago, and we've seen very much that there are other risks out there. So I'm still very much a believer that once the pandemic is behind us, once all of this dislocation is behind us, we're going to be back in an environment where we are persistently facing weak investment demand. The demography, if nothing else, will do that. It's secular stagnation, which is a doctrine that was been preached a lot by a guy named Larry Summers. And in a secular stagnation world, the one thing you really don't want to do is re-enter the world of secular stagnation with low demand, inflation that is too low. I mean, there's actually a pretty good case that says the 2% target is too low, but even you certainly don't want to come back into sort of normal economic times with inflation expectations having fallen to 1% or 0.5%. And there's a big risk if the Fed tightens too soon that it will end up having thrown away its ability to stabilize the economy once all of these pandemic-related shocks are behind us. Now, it obviously could go the other way, but I think they're really asymmetric. If inflation is running hot persistently, we know what to do. It's not pleasant, but we know what to do. You raise rates. If inflation is running too low and the economy is stagnating, then you actually don't have a lot of policy tools. I mean, you can use fiscal policy, except we're very likely to have governmental gridlock and when that comes around, and the Fed can only do so much.
Okay, it's always great to talk with you, Paul. Thank you very much for your time. That's Paul Krugman. He's Nobel laureate and distinguished professor at the City University of New York. Coming up, we hear from the White House on President Biden's Fed picks with Dr. Heather Boushey of the Council of Economic Advisors. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. President Biden made his long-awaited announcement today saying he will nominate Jay Powell for a second term as Fed chair and Lael Brainard to serve as vice chair. For a view from the White House of this historic decision, we welcome back now Dr. Heather Boushey of the Council of Economic Advisors. So, Dr. Boushey, thank you so much for joining us. Listen, all of us on the outside are dying to know what happened on the inside. As much as you can, tell us about the process here that gave rise to these decisions.
Well, the president has made very clear from day one that his North Star is making sure that we grow and support America's middle class. And so that really did inform his decision to reappoint Jay Powell to the chair of the Federal Reserve. over the past few years, we've seen this global pandemic, and yet the United States did not have a financial crisis because the Federal Reserve took steps to ensure that that didn't happen. Here we are too, in November of 2021 with an unemployment rate of 4.6%. And forecasters this time last year said it would have taken us another 2 years to get back here. And that's, of course, because of the steps that the president took in the American Rescue Plan, but it's also because the Federal Reserve has made it possible for the unemployment rate to come back down, that they have had the kind of monetary policy that was consistent with moving us back to full employment. So I think all of that really does speak to the fact that, the president wanted to appoint someone who would focus on making sure that we get the economy back to full employment and that we make sure to shore up America's middle class.
So, Dr. Boushey, obviously there's a church and state sort of separation between monetary policy and fiscal policy. And I'm not saying that the White House would try to run the Fed. At the same time, in reappointing someone, you want some expectation of what's going to happen. President Biden had some very nice things to say about Jay Powell and Lael Brainard in his announcement here. But what does the president expect out of this somewhat new leadership of the Fed?
Well, I think to some degree we know what we're going to get from this Fed if Jay Powell is confirmed by the Senate. It was back just a little over a year ago that he had the Federal Reserve go through a process to reevaluate how they make policy, and they came up with a framework that gives the Fed latitude to not only focus on price stability, but also to make sure that they are prioritizing getting back to full employment. So I think that says a lot. And then also, especially over the past year, the Federal Reserve has taken some significant steps towards addressing issues around one of the most important economic issues, which is climate change. The Fed has joined other central banks in the network for greening the financial system, and they've set up some internal committees to look at how climate change affects financial stability. So I think all of these things give us a clear sense of where the Fed will go in the years to come.
So Heather, you mentioned price stability and full employment, the two mandates of the Federal Reserve, and we just talked to Paul Krugman about that issue and what happens if they come into conflict. Because right now, price stability is, some people think, a little bit iffy with all the inflation we're seeing. At the same time, we're not getting to full employment. Where is the balance in your mind, in the president's mind? How much inflation are we willing to tolerate to make sure we get everybody employed?
Well, here's the thing. We have been making significant progress on getting the unemployment rate down. Been adding jobs to the tune of more than 600,000 a month over the course of the year. So that is slow, steady progress towards that goal and getting people back to work. And we've made more progress than many of our economic competitors. And at the same time, we know that people are seeing some higher prices at the gas pump, some higher food prices, and that's challenging for families. But the evidence really points to this being about the historic pandemic, about the supply chain challenges that we know that businesses have faced, not just here in the United States and around the world. And that is why the president has focused so much on unclogging the supply chains, making sure that the ports have the tools that they need to keep goods flowing. And in fact, that's what we've been seeing, especially over recent weeks. There's more stuff flowing through the ports now out on the West Coast than there ever has been. And major retailers are saying, hey, our shelves are fully stocked for the holiday season. So I think that there is a balance here, but it is really important to the American people that we get that unemployment rate down and really appreciate the focus on that policy as well.
Dr. Boushey, you mentioned the price at the pump of gas, and we all see it when we fill up on the weekends, goodness knows. There are reports that the White House this week may well be releasing some of the Strategic Petroleum Reserve. I don't believe that announcement's been made yet, but give us, in a sense, from you as an economist, is there enough oil in the Strategic Petroleum Reserve to really make a difference in the price I pay for gasoline at the pump?
Well, let me say a couple of things about gas prices. So first of all, the president has already written a letter to the Federal Trade Commission asking them to make sure that the prices that we're seeing at the pump actually reflect the prices that those retailers are seeing, right? So what I mean is that we need to make sure that there aren't any shenanigans going on, that prices aren't being unduly raised because of competition issues. So that is one step that the president has already taken to make sure that we are keeping gas prices down. Now, the Strategic Petroleum Reserve, that is available to be released in times of national emergency and when the president thinks that it might need to be done. But here's the thing. We know that this is not just a challenge here in the United States. This is a global problem. We're not the only country facing these issues, but we remain optimistic that as we work our way through this pandemic, we will see prices overall continue to come down.
Okay, thank you so much. Really appreciate you being with us today. That's Heather Boushey of the White House Council of Economic Advisors. Coming up, we will hear from former Treasury Secretary Larry Summers on President Biden's Fed picks. This is Balance of Power on Bloomberg Television and Radio. Balance of Power on Bloomberg Television and Radio. I'm David Weston. For a look at how the markets are reacting to President Biden's Fed picks, we turn now to our stocks editor. He is, of course, Mr. Dave Wilson. So what are we learning from the markets, Dave?
Well, we're learning that there was a whole lot more doubt that Jay Powell would be reappointed than you might think up front, if only because, markets tend to like continuity. And so you have a Fed chair who's going to be reappointed, and it's steady as she goes when it comes to policy. But you look at the market reaction, it really kind of tells you how much of a sentiment there was that Lael Brainard might have gotten a job, that she might have kind of ratcheted back in terms of policy moves toward cutting back on bond buying or raising interest rates. You see it show up, especially with the 2-year Treasury note. In fact, the government sold some of those today, and that particular auction was not well received. So you're talking about a higher yield on the Treasuries that are coming than the ones that are in the market right now. I mean, you're talking about, a fraction of a percentage point, but enough to kind of show up in terms of the market's reaction here.
Yeah, and if you need reinforcement, take a look at the NASDAQ. Because everybody else is up, NASDAQ's down, and usually that's sensitive to the fear of increased rates.
Oh, absolutely. That's part of the mix as well. And, one thing that's interesting when you look through the market beyond that is that, you look at the best performing groups among the 11 main ones in the S&P 500 this year, you see energy at the forefront, and it's right there today. And, some of those groups are definitely performing as you might expect. Financial stocks, of course, companies tend to benefit from higher rates. They can charge more on their loans, make more on their investments. So they're among the best performers. And then you have the makers of consumer staples, food, beverage, tobacco. They haven't been so great this year, but they're moving higher as well. So the one group that's taken a hit here, communication services, and you have to take a step back and say they're part of the big tech category, you might say, because Google's owner Alphabet is there, Facebook is there, Meta Platforms to be more precise. So, you can kind of understand those moves in that context.
As you say, Dave, it's not a huge shift. At the same time, the markets are telling us they think maybe higher rates are coming.
They absolutely. I mean, that's what you're getting out of all this. And, you saw an initial pop of stocks. It came back, and it shows you that steady as she goes is definitely carrying the day.
Yeah, thank you so much to Dave Wilson. Coming up, we talk with former chair of the Council of Economic Advisors, Professor Laura Tyson of Berkeley. And this is Bloomberg. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. In Germany, a warning on the coronavirus from Chancellor Angela Merkel. Bloomberg's learned she told officials from her CDU party that the latest surge in infections is worse than anything the country has experienced so far. Chancellor Merkel added that hospitals would soon be overwhelmed unless the fourth wave of the virus is broken. Prime Minister Boris Johnson says nothing in the pandemic data shows the UK needs new curbs and that he expects people to resume working in their offices rather than stay at home as they have during the pandemic.
I know that there are some people who think that working habits have been remade by the pandemic and that everyone will be working only on Tuesday and Wednesday and Thursday in an acronym that I won't repeat. I don't want to be dogmatic about this, but I have my doubts. And it's not just that young people need to be in the office to learn and to compete and to pick up social capital.
Prime Minister Johnson addressed the virus protocol during a speech with business leaders at the Confederation of British Industry conference. President Biden is preparing to announce a release of oil from the nation's strategic petroleum reserve in concert with several other countries as soon as tomorrow. Bloomberg's Anne-Marie Hordern has learned that the U.S. could release more than 35 million barrels over time as the president tries to lower gas prices. The move, likely in conjunction with India, Japan, and South Korea, would be an unprecedented effort by major oil consumers to tame prices. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. When Lael Brainard worked at the Council of Economic Advisors under President Clinton, the head of the council was Laura Tyson. As Dr. Brainard put it in an interview, it was her first woman boss. Laura Tyson was also, by the way, the first woman to head the National Economic Council and chair the Council of Economic Advisors. Dr. Tyson is now a distinguished professor at the Berkeley Haas Graduate School of Business, and we welcome her now back to Bloomberg. So, Dr. Tyson, thank you so much for being here. I want to talk about Jay Powell, but let's start with Lael Brainard, because obviously you know her. She gave you credit in part for her career. Tell us what you know about her.
Well, she's a brilliant economist. She's devoted her life to public policy. She could have been a brilliant academic economist. I first ran into her as a White House fellow. She was a White House fellow. I was chair of the Council of Economic Advisors. She worked for me in her White House fellow position. And then she wanted to stay, and I wanted her to stay. So we made a pitch to get the rules adjusted in a way to allow her to become a member of the Council of Economic Advisors at the end of her White House fellowship. And I've stayed and I followed her career since then. I hope she thought I was a good female boss. I certainly think she's a great female economist.
Well, she certainly talked glowingly about you in interviews, no doubt about that. Let's go to one of the issues that she will confront along with Jay Powell. It's something you have written about, and that is the question of full employment. Because we've had very accommodative monetary policy for a good long time, and we had fiscal stimulus, and yet we're having a fiendishly difficult time getting everybody back to work who had been working before. Unemployment rate's down, but there are a lot of people sitting on the sidelines. Is there anything the Fed can and should do about that?
I'm not sure the Fed itself can do anything. I think the issue here is the Fed maintaining a stance of expansionary monetary policy to continue the recovery process. And the recovery process of GDP, we're now back, unlike the other advanced industrial countries, we are back to pre-COVID GDP. We are back to trend lines of personal consumption growth pre-COVID. There has been a dramatic economic recovery. The labor force participation rate staying down is a surprise. It is a surprise. And frankly, labor economists are a little uncertain whether that will be a structural change in the labor market, that you will actually see certain groups, what they responded to the pandemic, have decided that they, the retirees maybe don't want to go back to work as much as they might have otherwise. People who have childcare or household care responsibilities, maybe not going back to work as much as would have been the case pre-COVID. So I think we don't know. The challenge for the Fed is they have this maximum employment target. And there's some uncertainty about how to measure maximum employment. Has the labor market changed in a way post-COVID? I don't think we know the answer yet. It's a little too soon.
Is there another question about how much we're willing to pay, if I can put it in those terms, in inflation in order to try to get the incremental jobs hired? Because that seems to be what's going on right now. So let's keep it running hot. We've got inflation really high right now, in part because we're trying to get the last people in off the sidelines.
Well, I think that misses the reality of what's driving the inflation rate right now. And I don't think it is current monetary policy. I think it is a series of fiscal and monetary actions during the recession, the COVID recession, and that's affected the demand side of the economy. But we also have very, very significant ongoing supply side disruptions. So this inflation can't be understood just by looking at traditional demand stimulus measures or the demand side of the economy. It has to be looked at in terms of supply. So you mentioned earlier the issue of oil. So that market globally is being manipulated right now by the producers who are holding back supply. They are holding back supply as the demand for oil picks up because growth around the world is picking up. That's driving up price. You need to look at the supply side of this as much as the demand side. And I would argue even more.
How urgent a problem do you find inflation right now? How badly do we need to address it? And if so, how do you address it?
Okay, so I do think there's a lot of angst about inflation. I would say it's a bit hyped in a discussion. I do not think one of the tech CEOs recently called it hyperinflation. I don't, we're dealing with, by one measure, the highest inflation rate in 30 years. But that is a recent number. And I think a number of us believe, but there's risk around this belief, that that rate will start to come down. And it will start to come down because the supply side disruptions in the production of goods and services that people want to buy with their income, those supply side disruptions will ease. Perhaps the oil producers of the world will sort of get it together and say, wait a minute, we can't really manipulate, hold back production just to get the price up. Well, they've done it before and they seem to be doing that right now. But I do think the optimists, the Pollyannish, those of us who feel, I would not call us Pollyannish, we feel that there are a number of transitory elements to the acceleration of inflation, and that those will dissipate over the next year. The risk, those who are concerned say, well, what if you got it wrong? What the Fed is going to have to do at some point, sooner rather than later, is step on the brakes, And I personally feel there's no evidence that the Fed will need to do that. There's some debate about when they will pick up interest rates next year. Second half of the year, end of the year, 25 to 50 basis points. People debate that, but not massive. They can accelerate their tapering.
Dr. Tyson, let me sneak in one more on oil. You raised the question of oil, and the story is that the White House is about to, maybe this week, maybe even today, announce a release from the Strategic Petroleum Reserve. At the same time, OPEC Plus has said, if you do that, we'll just cut back more on production. Is this a fool's errand? I mean, this sounds like a basic game theory.
Well, I think there's a lot of risk to doing that because, the power that the OPEC group has much more supply under its control and therefore can make offsetting responses to a U.S. action. I personally would prefer, if the U.S. is going to do this, that we work with all the other nations. Okay, that's a signal. I mean, and I can see if we're poised to do it with other nations, what are the other nations? Let's look at the oil cartel, face them down and say, all of the major users here are trying to take price pressure off, do something. So I would say, yes, if we do it with other nations. And yes, there's a risk that OPEC will easily be able to offset it by cutting back production. Both things are true.
Well, we may know soon here. Thank you so much. Always great to have you with us. It's Laura Tyson. She's Distinguished Professor at UC Berkeley. Coming up, we hear from the former head of the Congressional Budget Office, Douglas Holtz-Eakin, about President Biden's picks for the Fed and a crowded congressional economic agenda. And tonight, Bloomberg Daybreak Asia will have an interview with Atlanta Fed President Raphael Bostic. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Is the Biden plan for the Fed pretty much steady as she goes, or will there be adjustments coming? Welcome now, Douglas Holtz-Eakin. He's president of the American Action Forum and former director of the Congressional Budget Office. So, Doug, always great to have you with us. I guess the question is, where is the Fed heading, and will it be any different? Because, we'll have Jay Powell. That won't be different, but we do have now a new vice chair.
I think this is a great move to sort of restore the tradition of continuity. When the chairman's done a good job, they get reappointed. I think Jay Powell's done a good job. The bad news is that he has a very different job going forward than he had in the past. He came into the Fed as sort of a hawkish voice, came to accept the need for letting the economy run hot prior to the pandemic, having an extraordinary response to the pandemic, I think, had a Fed that was unified behind that, and I think that's great. So he's going to now have a new vice chair to consolidate. I don't think that's a big challenge, but inflation is a big challenge. We have seen historically that central banks can get rid of inflation. They just can't usually get rid of it without incurring some sort of recessionary cost, and that's why central bankers hate inflation to crop up to begin with. So this is a tough moment, and he's the right man for the job, but it's a new job. It's not the same one he had before.
It's a really good point. Going forward, the downside risk may outweigh the upside potential. We'll see. I hope it all goes well, but it's tricky, as you say. But on the question of inflation right now, what's your prescription? We had Paul Krugman on earlier, and he said he agrees there should be tapering, maybe even faster tapering. What he's against right now is raising rates.
I think that's right. I mean, if you look at how the Fed has traditionally thought about the quantitative easing, the purchase of the treasuries and MBS, they view the stimulus as measured by the stock, so the size of their balance sheet. That means they're still expanding the stimulus, and there's really no need for that. So taper quickly so that you take that out and no longer have a stimulative stance from the quantitative easing, and then think about the rates. And I think that starts to look like the second half of 2022 and not before. And while it is true that I'm more concerned about inflation than some people, it is still a fact that there are some components of this that are one-time and transitory. We expect them to go away. I think inflation comes down, but it doesn't come down to 2. You're still looking at something that's maybe in the vicinity of 4 or 5 that you'll have to deal with rates beginning in the second half of next year.
Well, and let's be clear, at least my impression is an awful lot of the inflation we're seeing is because of fiscal stimulus as much or more than monetary stimulus. And the structure of this, even if Build Back Better gets enacted, it's going to taper the fiscal off of what we've had over the last 18 months. Goodness knows it has to.
Yes. In fact, you're starting to hear people talk about, fiscal drag and the move from an extraordinary expansive fiscal policy to one that's not. The footnote to all of that is, households have about $2.4 trillion that they saved during 2020 and the first half of 2021 that we think of that as stimulus that went out last year, but it's still sitting in bank accounts. So there's plenty of firepower for next year. I don't think we need to worry about, inadequate demand. I think the issue will be how much does the Fed have to taper the demand and how quickly does it have to do it in order to keep inflation from getting out of hand? I mean, right now we've got rising wages, we've had demand for labor that's been off the scale, and inflation expectations are rising. Those are all additional concerns to the sort of one-time hits on consumer prices. So the Fed does have some work to do here in managing expectations, and they'll have to get to it beginning with the taper.
Doug, you know Capitol Hill so terribly well. Give us a sense about the confirmation process for Jay Powell as well as Lael Brainard, what it looks like. You've got some Republicans saying they're in favor. On the other hand, you have Elizabeth Warren and a couple of other Democratic senators out against it.
Well, I think we'll see at least 3 Democrats vote against Powell. Elizabeth Warren's been quite clear about that. We had Sheldon Whitehouse and Jeff Merkley join that crowd on the grounds that he's not done enough on climate-related issues. But I expect him to be confirmed very solidly. Republicans are supportive, and that goes through without any real issue, in my view. The same I don't think could be said for Lael Brainard. While she'll be confirmed as vice chair, she had a tough road being confirmed as chair. So, these 2 confirmations are the right ones for this moment. Both will go through. It gives the Fed a very strong team. Yeah. I think that's the best possible configuration.
Strong team, but missing a key member, and that's the vice chairman for regulatory. Why wasn't that named at the same time, particularly given all the concerns expressed by people like Senator Elizabeth Warren?
I honestly don't know. I've been confused by their willingness to tolerate openings across the administration. This administration still does not have an OMB director. It still doesn't have a head for the Office of Regulatory Affairs. And it's left open board seats for a sustained period. I'm mystified by that, and I won't pretend to be able to explain it.
Okay, thank you so much. Always a joy to have you with us. That's Douglas Holtz-Eakin. He's American Action Forum president. Coming up, we're going to hear from former Treasury Secretary Larry Summers on President Biden's Fed picks. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. President Biden has made his picks for Fed chair and vice chair, and now it's up to the Senate to confirm them. For an early read on this process, we welcome now Bloomberg Washington correspondent Joe Matthew, host of Sound On Afternoons on Bloomberg Radio. Joe, thanks for being with us. Obviously, we talked earlier to Heather Boushey. White House is very pleased with their picks. What are the prospects up in the Senate? We've seen three, I guess, senators from the Democratic side complaining. We've also got some Republicans applauding.
That's right, David, and we've been hearing reaction from Capitol Hill since that news first broke. It will be rolled out formally here, I should note, in an event next hour here at the White House. We expect to hear from all three. President Biden will formally announce his picks. Powell and Brainard are expected to deliver brief remarks afterward. We've been hearing from Senator Sherrod Brown, for starters, who chairs the Senate Banking Committee, applauding both. Not a big surprise there, even going so far as to say he looks forward to working with both Powell and Brainard to stand up to Wall Street and stand for workers. A little bit different from the ranking member, Pat Toomey, who does support confirming Jay Powell, but says he's got great concerns about Lael Brainard and wants to meet with her about them. It is no mystery, and it's widely known that Senator Elizabeth Warren opposes a Jay Powell chair at the Fed, and she did reiterate that opposition in a statement a short time ago, pointing to banking regulations, climate, which we've heard, of course. Senator Jeff Merkley, a Democrat from Oregon, says he's a no vote. We heard as well from Senator Sherrod Brown, progressive Democrat from Rhode Island, who says he's disappointed in the Powell pick. And while he does favor Lael Brainard, he says he is hoping that Jay Powell will reassess his stance specifically on climate. The fact of the matter is, though, here, to your point, David, there are a lot of Republicans who are prepared to vote yes. And this pick, both of these picks, frankly, were made by President Biden to avoid a messy confirmation battle on the assumption and the belief that moderate Democrats and Republicans will help to confirm both. David?
Okay, thank you so much. And by the way, we will be bringing that event at the White House that Joe just talked about when it happens live. Thanks so much to Sound On host Joe Matthew. You can hear him every day of the week at 5 p.m. on Bloomberg Radio. Joining us now is former U.S. Treasury Secretary Larry Summers. He's also, of course, I'm delighted to say, a special contributor to Wall Street Week. So Larry, thank you so much for joining us at the last moment here. Give us your take on the combination. It's a combination now of Jay Powell and Lael Brainard.
I think it's a good choice. This is a good team at the Fed, David. I'm glad that the president made this choice. This is the team that guided us through the response to the financial crisis. Jay was at the helm, but Lael played a key role in the design of the facilities that enabled us to maintain much smoother financial markets and have a much more rapid recovery than people expected, particularly in the traumatic early financial moments of that crisis. I think that this is a moment when continuity is a very good thing to have at the central bank, and that's what we're going to have with these selections. I do think, as I've said many times, that the Fed, now that we're going to have a leadership team in place that's got a long runway, does need to do some very serious thinking about the inflation and overheating risk and the balance of risks. And I believe that we're going to need substantial further evolution in our basic monetary policies. But I think we've got two first-rate people in Powell and Brainard, and so I'm hopeful that that's what will be coming.
So Larry, exactly right. You and I have talked quite a few times now about your concerns about inflation, which thus far have been borne out, I think, to nobody's delight, including your own. What is the possibility of both staying the course and changing the course at the same time? Continuity on the one hand, but the evolution that you say is necessary.
Look, I think it's the essence of central banking and more generally the essence of policy, not to be completely predictable, but to be completely responsive. That is, you don't know what's going to happen in the future, so you don't know for sure what you're going to do, but you know you'll respond whatever comes. And what's come has been a superheated up economy, as manifest by the labor shortages, as manifest in the quit rate, as manifest in cost of living allowances coming back in wage increases, wage pacts, as manifest in the inflation figures. And so that's what you've got to respond to. And I'm hopeful that Powell and Brainard, working cooperatively, will lead the Fed in making just that kind of adjustment.
So Lael, I'm curious about, I'll call it a soft landing. From the very beginning, you said one of the concerns you had is that inflation would get out of control. The Fed would have to really act precipitately, and it would lead us into a recession. Where are we right now? Is there a way out of this now to really bring inflation back under control by the Fed, not fiscal policy, but by the Fed, that doesn't really lead to significant contraction of the economy?
We've got a lot of risks. We've, in my view, let it go too long. And the evidence is, it's a rule attributed to Claudius Sohm that if the unemployment rate goes up 0.5% from its previous minimum, then we always have a recession. And we've got unemployment coming down and very tight labor markets, and we're going to have to slow that up. And doing that in a gentle way that avoids a recession isn't going to be easy. But I know that both Jay Powell and Lael Brainard will be super focused on doing that in as accurate and precise a way as possible. They're both very serious analysts of the economy, and so I'm hopeful about what the play out will be.
Well, as you say, there are risks no matter what happens in many important policymaking positions. That's true. But give us your best guess right now in terms of tapering. We had Paul Krugman, who you've said he's a former classmate of yours, a friend, on earlier, and he said he was in favor of tapering, actually. And I think maybe even faster than what the Fed is doing at the moment. What he really has problems with is raising the rates. How fast would you taper if you were Fed chair now?
I'd be looking to end the mortgage-backed security purchases, which I think serve no purpose other than inflating the housing market, almost immediately. I'd be looking to accomplish the whole taper within about 3 months. And I'd be looking to the very real possibility, if things continue as they are, of raising rates not too long after the turn of the year. I think the risk analysis is very clear now. If we let inflation rise and become entrenched, we're going to be looking at least a marginal version of what Paul Volcker had to do in the late 70s and early 80s that has immense cost. If, on the other hand, we raise rates prematurely, well, Janet Yellen did that during her time at the Fed, and then the Fed reversed course and lowered them back all before COVID with no substantial damage to the economy. So I think the risk analysis points to not getting behind the curve. Another way to say it is when you're steering a very big ship that turns only sluggishly, when you see an obstacle, you kind of got to start turning long before you get near that obstacle. And that's what monetary policy is. It's a very, very long tiller because of the lags on the economy. And so you got to start making adjustments promptly. And so I think the Fed needs to recognize that. I'm guardedly optimistic looking at the trends in their rhetoric that they may get on the program and be responsive, because the data points do keep coming in ways that are concerning. And I think now, with all this overhang of political uncertainty past us, if Congress moves quickly, as I very much hope it will, to strongly confirm the Powell-Brainard team, I think that it will put us in a position to carry on as best as is possible monetary policies.
Larry, to what extent will the Fed be assisted in a battle against inflation by what's happening on the fiscal side? And by that, I mean this. A lot of the way we got into this, you've told us from the very beginning, you told me at the very beginning of the proposals from President Biden that the fiscal stimulus was just too big. Well, it's coming off now. It's going to go down. Next year is going to be less than it was this year, goodness knows, and the year after that, even less. Will that help correct the problem even without Fed intervention?
It will help. But I think, David, that we've still got a lot of banked stimulus from the support that was provided to the government provided by the government to households last year. And there's still a very big overhang of savings as that gets spent, as people respond to the fact that they've run down their credit and now they're in a position to run it back up. I think you're going to see strong stimulus-generated spending for quite some time to come. So I wouldn't exaggerate that. And that's why I think we need to be careful with respect to any new fiscal legislation to pay for it, and hopefully to pay for it in a relatively contemporaneous way. That's why that's one of the reasons I'm very unenthusiastic about the state and local deduction provisions that were contained in the House bill. Most fundamentally, I don't really see why people like me need a net tax cut. Very much the opposite seems to me appropriate for broad reasons in the country. But I also think that retroactive state and local deduction is something that's going to insert a lot of money into the economy at a moment when there's no particular reason to do that.
Larry, you, of course, are a macroeconomist, without a doubt. And so when you and I talk about the Fed, it's mainly about one half of the responsibility of the Fed. But there's another part of it, and that's the regulatory side. Something we did not hear today was a nominee for that other vice chair position in charge of regulation of the banks, which I know you take very, very seriously. Elizabeth Warren has really been pushing this hard. She's very disturbed by this nomination. What do you think about not nominating that person now? What's going on?
I suspect the administration just takes time to put its full slate together. The processes of vetting people these days are extremely elaborate. And I've got confidence that President Biden, Janet Yellen, Brian Deese, Kathy Russell, who heads White House personnel, will make a good choice. Look, what I hope for is somebody who is deeply committed to rigorous financial regulation in the way that I think is necessary, in the way that Dan Tarullo was during his time at the Federal Reserve. At the same time, I have to say that I don't think we should be appointing someone who believes that banks should be replaced with a public utility, or who believes that banks should be removed entirely from the business of risk taking, as some of the statements from the administration's comptroller nominee has suggested. So I think there's room for substantial change from the policies that were pursued by outgoing regulatory vice chair Randy Quarles. And frankly, I think Jay Powell could use pressure from the pro-regulatory side from within the Board of Governors. But I think it has to be balanced, and that sometimes Senator Warren can overstep in her enthusiasm for attacking financial institution success. You know, I think, David, if I can just say one more thing, I think in a way, the most significant of the statements your Washington correspondent referred to was the statement that Senator Sherrod Brown had endorsed this pick. Senator Brown from Ohio is an extremely strong supporter of labor interests, a very strong progressive in favor of working people. He's been very concerned about financialization, yet I think he's come to the right conclusion that this is a set of nominations that should be supported, and should be complemented by a sensible, tough regulator. That's what I hope and expect we'll get.
One more, and believe it or not, it's on oil, Larry, because reports are, including Bloomberg is reporting, that the president is about to have a release from the Strategic Petroleum Reserve, perhaps in conjunction with some other countries. At the same time, OPEC Plus is saying, you do that, then we'll just supply more oil ourselves, and we'll make up the difference, or we'll cut back on production, rather. What do you make of that? Is this a fool's errand to try to affect the price of gas at the pump through the Strategic Petroleum Reserve?
I think it's probably a good thing. I would, on balance, support it. I don't think anybody should suppose that it's going to have a huge impact. But here's what I would look at, David. The oil curve is backwardated. What that means in finance talk is that the price of oil today is considerably higher than the futures market for a year from now. What that means is that you can sell the oil and buy it back a year from now and make a profit, and at the same time help the oil market right now. So if it was a very expensive thing to do, I probably wouldn't be in favor of doing it. But at a moment when there's a significant expected profit in the deal, it seems to me like it's a good thing to do.
Okay, Larry, I can't thank you enough for jumping in on this so quickly. That is our special Wall Street Week contributor, Larry Summers of Harvard. And you can hear Wall Street Week every Friday at 6 p.m. Eastern Time. President Biden is due to appear with his choices for Fed Chair Jay Powell and Vice Chair Lael Brainard a short time from right now, and we will bring that to you when it happens. But in the meantime, for a look at what all this could mean for investors and the market and the economy, welcome now Diane Swonk. She's chief economist at Grant Thornton. So, Diane, thank you so much for being with us. Really appreciate it. What's your reaction as someone who is really very cognizant of the markets but is an economist?
I think it's great. It's a dynamic duo having both Brainard and Powell and the continuity. Powell has brought, both of them have brought something very different to the Fed, and they work very closely together anyway. So elevating the voice of Brainard to vice chair is really important at this stage while keeping the continuity of Powell. Powell is much more, has a lot of humility when it comes to forecasting, where we've seen other economists have more hubris about the Fed's ability to forecast, and Powell's also shown an ability to pivot, which is, I think, very important. They left the door wide open. I'm really glad that this nomination came before we got the minutes from the last FOMC meeting, because I think it's very clear from the rhetoric we've already heard that a lot on the Fed have already moved over to wanting to accelerate that tapering that Larry was referring to. They want to do that in December. They left the door wide open to do that. That's important to do. And then get that separated from the process of liftoff, which I actually do think will be seen by mid-2022. I think it's important, though, that the messaging really get right here, because one of the things that Brainard and Powell are both very cognizant of and have sort of abandoned other Fed chairmen, and I'm thinking of them as a 1-2 punch on this, is they bring the international perspective to this, that the Fed is the central bank to the rest of the world. And you don't want to have a taper tantrum. You don't want to accelerate things so much that and rate hikes so much that you won't overshoot, that Larry was talking about, the fear of, how do you get a soft landing and you don't want to have this thing sort of get out of control on you. You want the Fed to be prudent but not panic in rate hikes. And Powell has said they'll be patient but not hesitate. Now I want them to be prudent and not panic. And I think having that international lens as well, understanding that whatever happens in the U.S. doesn't stay here, that there is no Las Vegas in the global economy, and that there could be repercussions in many developing economies, something that Larry had to deal with when he was Treasury Secretary. We don't want that washing up on our shores back in the United States right now. We want to have as much smooth in this as possible. It's very hard to do because now the Fed is going to be chasing down inflation, which it hasn't really done in a very long time. It's preempted a non-existent inflation for the better part of 30 years.
Diane, that points me to the question, because you're saying we need to make a pivot. We don't want to panic. We don't want to do it too fast. It's really difficult to get it just right. So in your view, what is right? I mean, you heard Larry Summers saying, he thinks they should get rid of the MBS at the end of this year, and they should, by the first quarter next year, be out of the business and start thinking about raising rates. How fast should they make the pivot toward tightening?
Well, I think, first of all, you have to lift your foot off the accelerator, and that means accelerating the tapering process. And so I would like to see them wrapped up with their tapering process somewhere by the end of the first quarter, beginning of the second quarter, so that we can actually get into the process of thinking about liftoff in rates. I actually have a liftoff in rates in June of 2022, so I guess I'm not that much different than Larry. And I have 3 rate hikes next year because I think the economy is going to be strong enough to withstand that. I also think there's not going to be the conflict between getting to that full employment mandate. I have to sort of put this one caveat in there, and that is that central bankers are hardwired to be more worried about inflation than employment, and Powell and Brainard really do bring some of that balance to the board to sort of keep us on that balance. And I think that's important because that gets to the point of panic. You don't want the Fed looking like it's panicking and then get ahead of itself on rate hikes and preemptively derail the recovery as well. I do think some of the inflation that we're seeing will uncoil in supply chains, but it's not as transitory as the Fed had hoped. It's much hotter than the Fed had hoped. I had wished they had tapered sooner, but it was a tough call. It's not my position to sit in that position, but I think what they need to do now is be very careful in their messaging and how they deal with this, that they'll be prudent in rate hikes to accommodate and respond to an economy that is more robust and is warmer. It's not stagflation. This is really, it gets politicized, and it's really tough to stay above the political fray of inflation in yet another election year. And that's what the Fed has to do. And I think this appointment helps them get there.
One aspect of this economy seems to be a lot of money sitting in personal accounts in the households right now that came out of the fiscal stimulus, pushing up against the restrictions on the supply chain that you referred to. From where you sit right now, are you seeing that ease up on the supply chain, and how fast is it easing up?
So it's not easing up as fast as any of us would like, but there is some uncoiling in the supply chain. We are seeing shipping costs come off a bit. We don't expect the supply chain issues to be resolved until well into the second half of 2022, or at least well into the first half. That is still a long ways away, so that's still some upward pressure on prices out there that we have to work out. And even though production in the auto industry is finally picking up, which is great, we're finally getting some chips out there to be able to keep production up, it's only meeting that it's still a shortfall compared to the demand out there. And so we have to get through all of that as well. And I think that's where it gets really tough, is timing this, because we really are also, at the same time all that's happening and all these supply chain problems are happening, we've also got $2.5 trillion in excess savings. I think most of that's in wealthy households. I'm not as convinced as Larry is that that's in the low-income households that have lost their unemployment insurance and lost their supplements to unemployment insurance. I think that's in high-income households that aren't going to spend a lot of it. And so as we get into 2022, although I think demand will still be strong, it will start to normalize as we get into the year. And that's what the Fed's going to be very careful on watching. They have to watch how much do we normalize, how much, what's the wild card of how much of that excess savings really shows up in terms of spending. My guess is a lot of it doesn't show up in terms of spending. We will lever up again. And what is really different, and to give, I think it's important on the froth in the housing market, I actually am very concerned about that. We now have investors coming into the housing market. Larry alluded to that as well, the froth in the housing market. But we also have, for the first time, unlike 2008, 2009, people have equity in their homes. They can leverage and tap that equity. We have to watch that as well.
So our TV and radio audiences, we are waiting right now for President Biden to appear to introduce his nominees for the Fed chair. Once again, Jay Powell and Lael Brainard for the new position, her new position at least, for the vice chair. We'll bring you that as soon as it happens, and we'll keep our eye on that. TV people can see there the podium as it's set up. So Diane, let me ask you one more question here, if I may, and that is participation rates in the labor market, because one of the concerns is wage increases, which might be structural if in fact none of those people are coming back in. Do we have a potential problem if, in fact, we just have fewer workers available?
We do, if we have fewer workers available. And, some of it is good news. We've got 1 million fewer workers today than February 2020 that are working multiple jobs. And to me, that's sort of a I hope that's because wages have come up enough. It's more a testimony to how low wages were in the best of times in the last expansion than to how high wages are today. But that also means 1 million fewer jobs that we get counted out there because they're not working double jobs. And so going forward, we do need to bring some of these people back from the sidelines, and the pandemic has played a huge role with childcare. I have one of my colleagues who had her child go back into quarantine, and even though her child had gotten her first vaccine, still has to quarantine for 10 days and be home from school. That disruption, if she was working hourly and not able to work from home, that would have meant she would have lost 10 days of pay. So I think we really have to be cognizant that we're still in a pandemic, and until we get out of this pandemic, we can't really count on labor force participation coming back. But I am a little bit more concerned about how much labor force we can bring back in from the sidelines as well, given the sheer volume of people, the number of people, 3 million excess retirees as well, and they're sitting on a lot of wealth. To bring them back in, employers are going to have to start casting a much broader net than they have in the past and get rid of some of the ageism and many of the biases that we saw out there. And that, I still think, is someplace we have a long way to go.
Okay, thank you so much, Diane. Always great to have you with us. That's Grant Thornton, Chief Economist Diane Swonk. And as we wait now for the President of the United States to appear with Jay Powell and Lael Brainard, we want to get a quick remark now from French Hill. He's a Republican congressman from Arkansas who also served as Deputy Assistant Secretary of the Treasury under George Herbert Walker Bush. So, Congressman, are you there?
I am, David. Good to hear your voice.
Well, it's great for you to be there. We're waiting right now for the President of the United States. Give us your initial reaction to this nomination that's coming of Jay Powell, once again for chair, and then for Lael Brainard as vice chair.
I think President Biden's made a good decision in reappointing Jay Powell as chairman of the Federal Reserve. We need that continuity. Markets need that continuity. Jay Powell did an outstanding job leading the Fed through the worst of the pandemic. And it's good to have that continuity as we now push back against what concerns me the most now, which are the inflationary pressures in our economy that you just discussed. And that's both a monetary policy issue and, of course, a fiscal policy issue. We need a steady hand at the Fed.
Well, that's what I'm curious about, Congressman, because on the one hand, this is a steady hand, it's staying the course. On the other hand, there needs to be something of a pivot, I take it, to deal with inflation. Are you confident that Jay Powell and now Lael Brainard are the people who can make that pivot quickly enough and deftly enough to really keep inflation from getting out of control?
Well, David, this has been building really since the financial crisis. We really, as you know, really never disengaged from quantitative easing after the 08 to 10 crisis. We slowly began that effort in 2019 and then stopped it. Then we fell into the pandemic. But it's that experience that Jay Powell has, having served as a governor and as chairman both, that I think give him that practical experience on how to navigate withdrawing that accommodation in order to not see this inflation take hold in our economy.
Okay, Congressman, thank you so much. We see President Biden coming out right now, but that's Congressman French Hill of Arkansas, and this is President Biden.
I want to comment on the tragedy that occurred last night during the holiday parade in Wisconsin. While we don't have all the facts and details yet, we know this morning that 5 families in Waukesha are facing fresh grief of a life without a loved one. At least 40 Americans are suffering from injuries, some of them in critical condition. And an entire community is struggling to cope with the horrific act of violence. Last night, the people of Waukesha were gathered to celebrate the start of a season of hope and togetherness and Thanksgiving. This morning, Jill and I and the entire Biden family, and I'm sure all of us, pray that that same spirit's going to embrace and lift up all the victims of this tragedy, bringing comfort to those recovering from the injuries, and wrapping the families of those who died in the support of their community. We're all grateful for the extraordinary work of the first responders, from law enforcement to the emergency room doctors, who are working around the clock to deal with the terrible consequences of what happened last night. My administration is monitoring the situation very closely. But now let me turn to today's announcement. 20 months ago, the COVID-19 pandemic exploded in America, creating the worst economic crisis we faced since the Great Depression, wreaking havoc not only on our economy, but the economies across the world. In just 2 months, over 20 million Americans lost their jobs, and unemployment rate shot up to 14.8%, the highest ever recorded in America. And all of you remember those scenes. Major cities and small towns, main streets that looked like ghost towns, boarded up businesses, empty roads, empty highways, empty airports, and empty train stations. Offices were closed, schools were closed, and hospitals were taken to the breaking point. When you remember the depths of the crisis we faced, it's all the more amazing the progress that we've made since then. We've gone from an economy that was shut down to an economy that's leading the world in economic growth. We've gone from small businesses being shuttered to a record number of new small businesses starting up. And we've gone from a devastating job destruction to record new job creation. Don't get me wrong, we still have a long way to go to fully recover from all the pain and destruction caused by the pandemic. And we're still dealing with the difficult challenges and complications caused by COVID-19 that are driving up costs for American families. I know for a lot of Americans, things are still very hard, very hard. But if you look at all the facts, you can only come to one conclusion. We've made enormous progress in this country. First and foremost, our economy is creating jobs, lots of jobs. In fact, we've seen a record new job growth in America this year, 5.6 million jobs just since I was sworn in January the 20th. More jobs created at this point in a new presidency than ever before in American history. We have seen a dramatic drop in the unemployment rate from a high of 14.8% in April of 2020 to 4.6% today. Earlier this year, independent experts were predicting it would take until the end of 2023 to see unemployment that low. Our economy is creating new businesses, lots of new businesses. In fact, Americans are starting small businesses at a record rate, up 30% compared to before the pandemic. Economists will tell you that an increase in new businesses is one of the best signs of an economy that's becoming more innovative and more dynamic. And that's because small businesses aren't just the heart and soul of America. They're not just the bedrock of so many communities across the country. America's small businesses are the primary job creators, innovators, and drivers that power our economic progress. That's why it's a powerful statement of the faith that we have in our country, where our country and our economy is heading. That small business creation is surging in America today. Which is why I'm proud to say, if you look at my presidency so far, it's a jobs presidency, and it's a small business presidency. So, if you look at the facts, here's what the record shows. Record job creation, record economic growth, record new small business creation. That's the story that should give us confidence about the economy that we're building. Confidence in ourselves, confidence in the future. Now, after years of wages being flat or falling behind, we're also seeing something else. Things are getting better for American workers. Higher wages, better benefits, more flexible schedules. Balance sheets for American families are better as well. Savings are up, home equity is up, credit card balances are down. And if you continue and combine the wage increases we've seen with the direct relief my administration has provided to middle-class families, the typical middle-class family's disposable income has actually gone up 2% this year, even after accounting for higher prices. That's the kind of recovery, just 1 year after a crippling worldwide economic crisis, that's unprecedented. And it takes us, it makes us stand out from the rest of the world. America is the only major economy, the only one in the world where the economy is bigger today and families have more money in their pockets today than before the pandemic hit. That's even after accounting for inflation. None of our competitors internationally can say that. None. It's a testament to the hard work and perseverance of the American people. It's a testament to the effectiveness of the vaccines and our vaccination effort. And it's a testament to the economic policies we fought so hard to pass and put in place, especially the American Rescue Plan. And it's a testament to the Federal Reserve. But for all the progress we've made, we know we still are faced challenges, serious challenges. We know there's a lot of fear and uncertainty in the country. We know it's tough for families to keep up with the rising cost of gasoline, food, housing, and other essentials. It's not just an American problem. It's a worldwide problem. Doesn't make it easy for Americans, but it's a worldwide problem. Every country is dealing with the same problems emerging from the pandemic. Supply chain bottlenecks, disruption caused by spikes in COVID-19, elevated prices. They're all taking a bite out of our family budgets. Perhaps no entity plays a more important role in navigating these challenges than the Federal Reserve, because it's the Fed's job to balance two key goals. The first is to achieve maximum employment, to get as many Americans working as possible. And the second is to keep inflation low and stable. To meet these goals is going to require patience, skill, and independence. That's why today I'm nominating Jerome Powell for a second term as chair of the Federal Reserve. And I'm nominating Lael Brainard to take the position as vice chair of the Federal Reserve. When our country was hemorrhaging jobs last year and there was panic in our financial markets, Jay's steady and decisive leadership helped to stabilize markets and put our economy on track to a robust recovery. Jay is a believer in the benefits of what economists call maximum employment. That's an economy where companies have to compete to attract workers instead of workers competing with each other for jobs, where American workers get steady wage increases after decades of stagnation, and where the benefits of economic growth are broadly shared by everyone in the country, not just concentrated for those at the top. Jay said it well last month, and I'm going to quote him. He said, and I quote, "An economy is healthier and stronger when as many people as possible are able to work. If entrenched inequities prevent some Americans from participating fully in our labor markets, not only will they be held back from opportunities, but the economy overall will not realize its potential. And those who have historically been left behind stand the best chance of prospering in a strong economy with plentiful job opportunities," end of quote. As chair, Jay undertook a landmark review to reinforce the Federal Reserve's mission toward delivering full employment. We're making strong progress toward that goal now. And I believe Jay is the right person to see us through and finish that effort, while also addressing the threat of inflation that it poses to our families and to our economy. Jay and I have had a chance to discuss his views on priorities for the Federal Reserve in the years ahead. He's made clear to me a top priority will be to accelerate the Fed's effort to address and mitigate the risk that climate change poses to our financial system and our economy. Extreme weather has cost our economy over $600 billion over the last 10 years. We have to make sure our financial system can withstand climate change and is prepared to transition to clean energy. The Fed must be a leader among central banks globally in addressing climate-related financial risks. He's also underscored the importance of the Fed taking a more proactive role in the months and years ahead in making sure that our financial regulations are staying ahead of emerging risks, be they from innovations in cryptocurrency or the practice of less regulated non-bank financial institutions. Having served as vice president during the depths of the 2009 financial crisis, and having worked with President Obama to put in place a stronger financial rules of the road, I understand the stakes of our regulations falling asleep at the switch, regulators falling asleep at the switch. Jay, along with the other members of the Fed board that I will nominate, must ensure that we never again expose our economy and American families to those kinds of risks. I respect Jay's independence, and I also trust that he will follow through on his commitment to prioritize these issues with the skill that he has shown in his service to date. Now, Some will no doubt question why I'm renominating Jay when he was the choice of a Republican predecessor. Why am I not picking a Democrat? Why am I not picking fresh blood or taking the Fed in a different direction? Put directly, at this moment, both enormous potential and enormous uncertainty for our economy, we need stability and independence at the Federal Reserve. Jay has proven the independence that I value in the federal chair, in the Fed chair. In the last administration, he stood up to unprecedented political interference, and in doing so, successfully maintained the integrity and credibility of his institution. It's just one of the many reasons why Jay has support from across the political spectrum. In 2018, he was confirmed with 84 votes in the United States Senate. His approach as Fed chair has earned the respect and support of groups from the AFL-CIO to the Business Roundtable, which brings me to one more reason I've chosen to renominate Jay. I believe having Fed leadership with a broad bipartisan support is important, especially now in such a politically divided nation. I believe we need to do everything we can to take the bitter partisanship of today's politics out of something as important as the independence and credibility of the Federal Reserve. This is vital to maintaining public trust in an independent institution like the Federal Reserve. And that is why I'm so proud as well to nominate Dr. Lael Brainard, to serve as Vice Chair of the Federal Reserve. By promoting Lael today to Vice Chair, I'm elevating one of the country's most qualified and dedicated public servants. She's one of the nation's leading macroeconomists. She spent years at the Treasury Department representing American capitals around the world on international economic issues. And she spent nearly the last decade as a member of the Fed, most recently working side by side with Jay as the Fed navigated historic economic and financial crises and reaffirmed its commitment to a full employment economy. Throughout her time at the Fed, Lael has also been a steadfast voice for tough rules to protect the pensions and savings of the American people. She's led the Fed's efforts to make sure the banking system serves everyone in the communities they serve, so that regardless of where you live or your background, every American can have access to credit they need to start a business, buy a home, and just have a fair chance in life. She's done pioneering work on how the Fed should account for the emerging risk of climate change to our financial system. And like Jay, her expertise and leadership have earned her the respect and support of Republicans and Democrats alike. I'm proud to nominate her to the vital role of Vice Chair of the Federal Reserve. Beyond Jay and Lael, I look forward in the coming weeks to nominating additional members of the Federal Reserve Board of Governors, including a new Vice Chair for Supervision. These individuals will help safeguard our financial system, and alongside Jay and Lael's leadership, help to support and continue this historic economic recovery. While Jay and Lael bring continuity and stability to the Fed, my additions will bring new perspectives and new voices. I also pledge that my additions will bring new diversity to the Fed, which is much needed and long overdue in my view. Last year, the pandemic shut down much of the global economy. Now there's a worldwide reawakening, and it's creating both an incredible opportunities and tough challenges. As economies all across the world come back from this pandemic, America's leading the way. Like every country in the world, we have to deal with these issues of rising costs. But we should remember, we have the skill and the tools to get it under control. While other countries are stumbling out of this pandemic, we're racing ahead because so much of the rest of our economy is doing well, because we have created so many new jobs as fast as we have. We're in a position to attack inflation from the position of strength, not weakness. In times like these, we need steady, tested, principled leadership at the Fed. We need people with sound judgment and proven courage to preserve the independence of the Fed. And we need people of character and integrity who can be trusted to keep their focus on the right long-term goals of our country, for our country. I'm confident Jay and Lael are those people. Now I'd like to give both Jay and Lael an opportunity to say a few words. And we're going to start with Jay, and then I'm going to turn to Lael. Jay, the floor is yours. You're over this side.
Mr. President, thank you for this extraordinary opportunity to continue to serve the American people. If confirmed by the Senate, I pledge to do everything within my power to meet the responsibilities that Congress has entrusted to the Federal Reserve. I'm joined today by my wife, Alyssa Leonard, and our 3 adult children, Susie, Lucy, and Sam's wife, Alyssa. Their love and support underpin and make possible all that I do. I'm also grateful to the exceptionally talented and dedicated team at the Federal Reserve, with whom it has been my great privilege to serve over the last decade. My predecessor, Secretary Janet Yellen, left the Fed in a strong position to meet every challenge, and I'm thankful for her leadership, her example, and her friendship. When COVID hit our shores, American families and businesses were 10 years into historic economic expansion, with a robust jobs market that was reaching even those who had traditionally been left out. The pandemic, however, brought an immediate and painful recession. Fortunately, American resilience, along with strong policy actions and vaccines that enabled the economy's reopening, cushioned the blows and set the stage for a strong recovery. Today, the economy is expanding at its fastest pace in many years, carrying the promise of a return to maximum employment. Challenges and opportunities remain, as always. The unprecedented reopening of the economy, along with the continuing effects of the pandemic, led to supply and demand imbalances, bottlenecks, and a burst of inflation. We know that high inflation takes a toll on families, especially those less able to meet the higher costs of essentials, like food, housing, and transportation. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. Other key priorities include vigilantly guarding the resilience and stability of the financial system, addressing evolving risks from climate change and cyber attacks, and facilitating the modernization of the payment system while protecting consumers. I look forward very much to continuing to work closely with my colleague of the past 7 years, Lael Brainard, as the Fed confronts these and other issues. Lael brings formidable talent, a wealth of experience, and good judgment to our work. Inside the Federal Reserve, we understand that our decisions matter for American families and communities. I strongly share that sense of mission, and I'm committed to making those decisions with objectivity and with integrity, based on the best available evidence in the long-standing tradition of monetary policy independence. Mr. President, thank you again.
Now I'd like to give the floor to Dr. Brainard.
Mr. President, thank you. I'm deeply honored that you're entrusting me with this responsibility at a critical time. I'm committed to putting working Americans at the center of my work at the Federal Reserve. This means getting inflation down at a time when people are focused on their jobs and how far their paychecks will go. It means supporting a growing economy that includes everyone. It means ensuring that financial markets are thriving and resilient, and the economy is sustainable for future generations. It means serving all Americans in every community across the country and ensuring the Federal Reserve reflects the diversity of the communities we serve. I was privileged to work with Chair Powell as we made every effort to protect workers, businesses, and families from the COVID financial shock with the support of Congress. And I look forward to working with him in the months and years ahead to build a durable recovery. I also want to thank Secretary Yellen, with whom I've also been privileged to work. I'm grateful to the many people who've supported my efforts. As a working mom, I'm especially grateful for the love and support of my 3 dynamic daughters, Kaylin, Kira, and Coco, who took the afternoon off from school, my deeply devoted husband, Kurt, Aunt Vivian, my sisters, and my amazing mother, Joanne, who's here with me today. I'm confident that by working together, we will see a strong recovery for all Americans. Thank you.
Thank you. Well, folks, that's it. Hope you have a happy Thanksgiving. And I thank the families of the two nominees for being willing to support their work and what they have to do. It's going to be a long hours, as you already know, long efforts, and I thank the families. Thank you all.
So we have been listening to President Biden, along with his two nominees to the Fed. That is Jay Powell, the current chairman, nominated now for a second term, as well as his nomination for the vice chair. She is Lael, who has been on the Fed for some time now, but now she will be moved up, provided there's confirmation, to being vice chair, the second most important position. The president emphasized repeatedly a steady, decisive, and independent Fed is what he wants. He talked about independence more than once. He also talked about full employment, the importance of everyone being employed. Also, with respect to Jay Powell, he said that it's important that he is bipartisan, he has bipartisan support. And then we heard from Jay Powell and from Lael Brainard, both of whom, I must note, thanked Secretary Yellen, Treasury Secretary Yellen, with whom they had served. So we're now going to turn to our roundtable. Before that, I want to have a small correction here. Earlier in our programming, as we were leading up to this, we mistakenly referred to Sheldon Whitehouse as somebody. We especially talked about Sherrod Brown, the senator, Democratic senator from Ohio, as being lukewarm about Jay Powell. That's not right. Sherrod Brown came out with a very strong supporting statement for the nomination of Jay Powell. It was a confusion with Sheldon Whitehouse, who in fact has opposed the nomination of Jay Powell, saying that we need somebody who will guard the financial system better and also address climate change. So once again, there's no question but that Sherrod Brown very strongly supports Jay Powell's nomination. Now we're going to turn to our roundtable of Peggy Collins. She is the relatively new bureau chief from Washington, as well as our senior markets editor. He is John, authors of Bloomberg Opinion. So welcome to both of you. So Peggy, start with you. What do you make out of this?
Well, I think the combo today was obviously something that a lot of us were waiting for, and markets were certainly waiting for and wondering why it was taking so long. But the combo today has been taken in markets as a strong sign that there will be consistency at the Fed. And I think the duo is important in the sense that the two of them are seen as somewhat similar on monetary policy, but Brainard is seen as stricter on financial regulation. And while she's got the vice chair role as opposed to the vice chair for supervision, she can still take leadership in this role. So I think we'll see that. And as you mentioned, Biden talked a lot about climate change, and she is seen as being forward and forward running on that.
Well, I'm curious about that. If I could just follow up with you, Peggy, why didn't they name the vice chair for supervision at the same time? That is a terribly important position, particularly if you listen to somebody like Senator Elizabeth Warren.
Well, it was a bit of a surprise to us this morning in the sense that Lael Brainard is seen as one of, if not the most qualified in terms of for the position of vice chair of banking supervision. But I think the vice chair role is certainly a very public-facing role. It's considered the Fed's number 2 spot, and I think together they present a very, as Biden said multiple times, a steady presentation in terms of where the Fed is going when it faces key issues for the economy and for the American people right now, with inflation soaring, and also we're not back to where we were in terms of jobs before the pandemic broke.
Well, let's talk about that inflation soaring. I turn to John Authors now. John, thanks so much for being with us. That's something you've been monitoring very closely. You have your own way of monitoring inflation. You're concerned about inflation. Give us your sense about what this Fed, new Fed, old Fed, I'm not sure what you want to call it, how is it going to really feather this, actually keep on the same course, but at the same time turn course?
Basically, nothing has changed in an assessment on that since yesterday, because we basically have exactly the same cast of players in place, and because, frankly, monetary policy, even though that's by far the most important element of this choice by President Biden, was never up for grabs. Brainard and Powell have agreed with each other on monetary policy in every single vote they've ever taken over the 7 years that they've jointly been on the Fed, and there was no public discussion by them as to how they might differ on monetary policy. I thought in terms of how it was presented, I agree completely with Peggy. I'm surprised that Lael Brainard wasn't also given the supervision, the regulation role. That had been much discussed as a way of splitting the difference between these two candidates, keeping all people happy. But the other point that did occur to me quite strongly as we were listening to Biden was that he was obviously talking more to Democratic senators than to anybody else. He was trying to cast Jay Powell as a figure who really cared about full employment and who was going to make a priority out of combating climate change. And I don't think those were things that President Trump particularly had in mind when he first appointed him. And it's also very intriguing how much he has put on the notion of stability and independence. At this point, there is arguably nothing in the domestic arena that is more dangerous to Joe Biden politically than inflation. And yet he has basically said, it's really not his job to fight inflation, it's the job of whoever he appoints to the Fed. And he is basically, I think probably correctly, but this is quite an alarming juncture in many ways, just said, OK, I have to leave it to these guys who are doing it now, even though, which nobody mentioned, they don't seem to have done a great job of it in the last year.
Well, John, I'm curious about one thing here. You say full employment. That sounds like a good thing. Who's going to argue against that? Yeah. On the one hand, fighting inflation, that sounds like a good thing. What if those two things are in contradiction with each other? What if, in fact, in order to get to full employment, you have to run an inflation hot?
Well, conventional macroeconomics suggests that those things can indeed be, and often are, in contradiction with each other. And that is where, arguably, the weakness of the whole current system of an independent Fed lies. They plainly have to try to get full employment and keep inflation under control. But it's not clear how they should prioritize those things, given that often prioritizing one will deliberately mean taking a risk on the other. If it were possible to have more of a sense of direction for a president and Congress to set much more precise goals, you might be able to thread the needle of having an independent central bank with the freedom of action that we saw last March a central banker really needs to have, but also some sense of democratic accountability. And we don't have that. That personally bothers me quite a lot, that there is no more important economic issue facing this country or the world, frankly, at the moment, than how to deal with inflation, how to prioritize inflation and unemployment. This was the opportunity to address that issue. And frankly, given the importance of the Fed in the economy at the moment, given the importance of stability and continuity in the Fed to keeping the markets happy and avoiding a financial crisis, there has been no progress in establishing some degree of democratic accountability over this.
Peggy Collins, as our Washington bureau chief, you're going to oversee the coverage of the confirmation hearings, all right, for what's going on here. We heard from John Authers there that the president, to some extent, was addressing Democratic senators to try to appeal to them. At the same time, does he need many of them? Because there are a fair number of Republican senators who've come and said that they sort of like the idea of Jay Powell staying around.
Well, I think on Powell, we're expecting a pretty easy confirmation process for him. As you said, David, he has spent a lot of time working and walking the halls of Congress on both sides of the House. So I think he's got a lot of support on both sides. And we do think that Lael Brainard will also have a somewhat easy time getting a confirmation too, especially since this isn't the vice chair of supervision role. That is really the one that gets in the crosshairs, where a lot of Democrats think that the Fed needs to be more aggressive in terms of financial regulation over banks and things of that nature.
Okay, thank you so much. Really great to have you both with us. That's Peggy Collins, as I say, a relatively new Washington bureau chief, and John Authers, who is our senior editor for markets here at Bloomberg. And now we'll be joined by Betsy Stevenson of the University of Michigan, the Ford School professor of public policy and economics. She is a former member of the Council of Economic Advisors, where she advised President Obama. So, Professor, thank you so much for being with us. Really appreciate it. You know particularly labor, as I recall. What about this issue about whether you have to pay in the coin of increased inflation in order to get the result of full employment?
You know, there's no long-run trade-off between inflation and unemployment. But what we're trying to do right now is steer the economy back to a place where all of our resources are used in the most effective way possible. That's getting all our workers back. That's getting all our factories back online. And everything's just a little mixed up right now because people are changing their priorities, both about what they buy and how they work. And so we've got, you know, we're far from full employment still, but we're seeing some inflationary pressure as people's demand has outstripped supply. And then we've had particular challenges with prices coming from goods overseas because of the supply chain challenges and the increased cost of shipping. So I do think it's very rocky waters right now. But I would have to say that I think if I was going to say what I thought the number one problem facing the globe right now, it's how to get everybody back to work into a place where they're going to be stable in a post-pandemic world, being able to be employed. And we don't see people trapped outside of the labor force for a long period of time.
That sounds like a very worthy goal. I dare say there aren't many people who disagree with you, but is that something that's within the Fed's power to do? Does it really have the tools to get that done?
Well, let's think about what the Fed is really doing when it raises interest rates. It's trying to figure out whether it should change the price of money today versus money that you spend in the future. So it could raise rates to try to discourage people from consuming today. That would bring down demand to try to curb inflation. But it also risks bringing demand down too much so that businesses stop hiring and people end up in a world where they don't get back to work and they end up with what economists fear of labor market scarring. So even if the economy gets strong again, they don't end up going back to work. And so sometimes it can be worth it, particularly coming out of a recession, to run an economy a little bit hot for a little bit of time so that we build labor force participation back up. We build that back up, not only by bringing people back into the labor force, but by making it such a good time to work that other people don't exit. So we sort of stabilize the labor force at a higher participation rate. That might risk running a little bit of inflation, but I have a lot of confidence that the Fed can bring inflation back down. I think that the president's done exactly the right thing by reappointing Powell and saying, we've got somebody at the head here who knows how to steer us through these rocky waters. I got a lot of faith in him. He has shown that he is able to learn from past mistakes. That's one of the reasons why he's running the economy a little hot right now. He's also shown that he doesn't bow to presidential threats, which he was faced with under President Trump. And so I think he deserves a chance to get us through this difficult time.
So give us your sense of why people are sitting on the sidelines, because my understanding is, last time I checked, it's not evenly distributed. We have a disproportionate number of women, particularly prime working age women, who are not coming back in the workforce, and also quite a few people of color are not coming back in. What are the factors? And the reason I ask the question is, if I understand the factors, maybe I understand better the means of addressing them.
And so it's a little bit of a misnomer, women not coming back as much. Women are coming back at roughly the same rate as men, but women lost a lot more jobs than men did. And it's the same thing with people of color. Look, the service sector hasn't recovered. All this inflationary pressure, it's coming from the goods sector. People are demanding goods at a rate that is way beyond not only pre-pandemic levels, but any kind of pre-pandemic trend. Everybody seems to want a new couch, a new car. They want stuff. They got to go back to buying services, childcare services, going to the dentist, going out to eat. There's a whole range of services, and women and people of color disproportionately work in services, and that's where the jobs haven't come back. So it's not all a labor supply story. There's some labor demand going on here as well. On the labor supply side, we do have families still struggling with childcare issues. The schools are back. But any day your kid could come home and say, Bobby, who sits next to me, has COVID, so they told me I can't come back for 2 weeks. That's a really tough way to manage employment. And a lot of employers aren't being exactly sympathetic to you calling up with no notice and saying, I need 2 weeks off.
Professor, address one other thing that got talked about by President Biden as well as his nominees here just a few minutes ago, and that's climate change and the proper role for the Federal Reserve in dealing with climate change. We understand the EPA, we understand the administration, what they can do about it, but how far should the Fed be going at trying to address climate change through monetary policy, or for that matter, bank regulation?
Climate change is the biggest threat we face over the longer period. And I think what we saw in the pandemic was a big threat like a pandemic. We absolutely needed the Fed. Same thing's true with climate change. We absolutely need the Fed. What the president said is he talked to Chairman Powell, he talked to Lael Brainard. He believes that they're willing and ready to do more. I hope that's right, because we are going to need to see all hands on deck when it comes to fighting climate change, and that includes the Federal Reserve.
One of the things that the president went out of his way to say is there are going to be some more nominations coming, and you'll see some diversity, something that people have been clamoring for. What do you expect?
I'm not going to begin to guess who he might nominate, but, he obviously had a lot of pressure to nominate people who haven't been serving on the Fed before, who might bring a different perspective. And I think that there is a really good slate of candidates he could choose from that would bring that diversity in.
Okay, thank you so much. Really great to have you with us, always is. That is Professor Betsy Stevenson of the University of Michigan. This is, of course, the end of our coverage of the nomination of Jay Powell for his second term. Coming up later today, there's going to be an interview on Bloomberg Technology with Democratic Virginia Senator Mark Warner, who is a member of the Banking Committee. Mark Warner will address what he thinks about these nominations of Jay Powell and Lael Brainard. And this is Balance of Power on Bloomberg Television and on radio.